Wall Street ended the week on a sour note, with the U.S. stock market taking a hit as the Dow Jones Industrial Average slid 202 points, the S&P 500 dipped 0.8%, and the Nasdaq Composite fell 1.3%. The declines, reported on August 29, 2025, capped a volatile month driven by renewed fears of inflation and uncertainty surrounding President Donald Trump's aggressive tariff policies. Investors, already jittery after a rollercoaster year, pulled back from equities, sending ripples through global markets and raising concerns about the economic outlook for both Wall Street and the average American. The cautious mood sets the stage for a potentially turbulent September, following a year where the S&P 500 had climbed 14.37% compared to the same period in 2024, according to trading economics data. The market's stumble was fueled by a potent mix of inflationary pressures and trade policy uncertainty. The Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditure (PCE) Index, is expected to show a headline figure holding steady at 2.6% annualized for July, with core PCE, excluding volatile food and energy prices, forecast to edge up to 2.9% from 2.8%, per Edward Jones. These figures, due for release on Friday, August 29, remain above the Fed's 2% target, stoking fears that inflation could creep higher. Fed Chair Jerome Powell, speaking at the Jackson Hole Economic Policy Symposium, hinted at tariff-related price spikes being temporary but acknowledged labor market softening might prompt policy adjustments, with markets pricing in 2 rate cuts for 2025, possibly starting in September. Lower rates could ease borrowing costs, but the threat of tariff-driven price increases has investors on edge. Trump's tariffs, a hallmark of his second term, have been a lightning rod for market volatility. Since April 2, 2025, when Trump announced sweeping 10% tariffs on nearly all U.S. imports, dubbed Liberation Day, markets have swung wildly. The policy, which included 25% levies on Canada and Mexico and up to 84% on China, triggered a historic sell-off, with the S&P 500 losing 10.5% and the Dow shedding 9.3% over 2 days in early April, marking the worst 2-day loss since the 2020 COVID-19 crash, per Investopedia. A brief 90-day tariff pause on April 9 sparked a rally, with the S&P 500 surging 9.52% in a single day, its largest gain since 2008, and the Nasdaq jumping 12.16%, according to Reuters. But renewed tariff threats, including a 50% hike on Chinese goods and 30% on EU imports, have kept markets skittish. J.P. Morgan estimates these tariffs could raise $400 billion in revenue, equivalent to 1.3% of U.S. GDP, but also boost PCE prices by 1–1.5% in 2025, intensifying inflation concerns. The local market felt the brunt of this uncertainty. In New York, the New York Stock Exchange saw heavy selling in tech and consumer discretionary sectors, with Nvidia dropping 6% and Apple falling 4.2% on Thursday, April 10, per CNBC. Retail stocks, like Nike and Lululemon, were hammered earlier in the year, with shares plunging 14.5% and 10% respectively on April 3, as tariffs threatened to raise costs for imported goods. Smaller companies, tracked by the Russell 2000, were hit hardest, entering bear market territory with a 6.6% drop on April 3, reflecting their vulnerability to economic slowdowns, according to PBS News. Financials, however, showed some resilience, with Discover Financial Services and Capital One gaining 7.5% and 3.3% on March 31, buoyed by merger optimism, per Reuters. For the common American, the tariffs spell higher prices and tighter budgets. The Tax Foundation estimates Trump's tariffs amount to a $1,304 tax increase per U.S. household in 2025, potentially rising to $1,588 in 2026. Everyday goods, from electronics to clothing, could see price hikes of 30 to 40%, as small business owners like Pat Muscaritolo of Jacobson Appliance in New Jersey warned customers to buy now before costs soar, per BBC. Consumers, already grappling with inflation above the Fed's target, face a squeeze on discretionary spending. For instance, a family buying a $1,000 refrigerator could pay $1,300–$1,400 post-tariff, eating into savings or forcing cutbacks elsewhere. The Conference Board's Consumer Confidence Survey for August showed a dip, driven by tariff fears and labor market concerns, with unemployment ticking up to 4.2% in April, per USA Today. Businesses, too, are reeling. Importers like VOS Selections, a New York wine distributor, have warned of potential closures due to tariff costs, while retailers like Best Buy saw shares plummet 17.8% on April 3 as global supply chain disruptions loomed, per PBS News. The agricultural sector, hit by China's 34% retaliatory tariffs, saw soybean and cattle futures drop over 2.5% on April 4, with companies like Archer Daniels Midland losing 10%, according to the New York Times. Conversely, homebuilders like D.R. Horton and NVR gained 4.5% and 4.2% on April 4, as falling Treasury yields, down to 3.86% from 4.8% in January, hinted at lower mortgage rates, per Investopedia. Globally, the tariffs have sparked a chain reaction. Japan's Nikkei 225 fell 2.77% and Europe's Stoxx 600 dropped 1.6% on April 3, with German retailers Puma and Adidas losing 9% and 8.6%, per CNBC. China's CSI 300 and Hong Kong's Hang Seng slid 0.59% and 1.52%, reflecting fears of a full-blown trade war. J.P. Morgan raised its global recession probability to 60% from 40%, slashing its S&P 500 year-end target to 5,700, while Oxford Economics cut U.S. GDP growth forecasts to 1.3% from 2%, citing a 24% effective tariff rate, higher than in the 1930s. The World Trade Organization's Director General warned of a cycle of retaliatory measures that could further erode global trade, per the New York Times. Investors are now bracing for what's next. The S&P 500, at 6,460 points on August 29, remains 17.6% below its February peak of 7,800, teetering on the edge of a bear market, per Trading Economics. The CBOE Volatility Index, Wall Street's fear gauge, hit 52.33 points on April 8, its highest since March 2020, signaling intense investor anxiety, per Reuters. While a recent trade deal with Japan, setting tariffs at 15% instead of 25%, lifted Japanese stocks by an estimated 3% in earnings, per J.P. Morgan, ongoing tensions with China and the EU keep markets on edge. The EU's decision to delay retaliatory tariffs for 90 days offers a glimmer of hope, but Trump's insistence on maintaining high levies on China, totaling 145% with fentanyl-related duties, suggests more volatility ahead, per CNBC. For the average American, the local market's woes translate to real-world challenges. Higher import costs could push grocery bills up by 10 to 15%, with a $100 weekly shop jumping to $110, $115. Gas prices, tied to West Texas Intermediate crude dropping to $60 per barrel in April, offer some relief, but tariff-driven inflation could offset this, with Goldman Sachs estimating a 0.7% rise in core prices from Canadian and Mexican levies alone, per Forbes. Workers in tariff-hit industries, like manufacturing and retail, face job uncertainty, with service sector hiring slowing in March, per the Institute for Supply Management. Meanwhile, the promise of lower interest rates, potentially dropping the federal funds rate from 4.75% to 4.25% by year-end, offers hope for cheaper loans, but the Fed's cautious stance, as voiced by Kansas City Fed President Jeffrey Schmid, suggests no rush to cut rates amid inflation risks, per CNBC. Looking ahead, the market's trajectory hinges on Trump's next moves. His administration's pause on some tariffs in April sparked a historic rally, but the threat of reimposing duties or escalating tensions with China could undo gains. The Supreme Court's pending review of the tariff legality case, following the Federal Circuit's ruling that Trump overstepped IEEPA authority, adds another layer of uncertainty. A decision to strike down the tariffs could refund billions to importers, boosting consumer spending but risking trade deal collapses, per Reuters. Conversely, upholding the tariffs could lock in higher prices, with UBS estimating a 2% hit to U.S. GDP and inflation nearing 5%, per PBS News. As September looms, Wall Street is gearing up for more turbulence. Corporate earnings, with 82% of S&P 500 companies beating estimates by 8% in Q2, per Edward Jones, provide a bright spot, but slowing growth projections, 10.5% for 2025 versus 12.8% in Q1, temper optimism. The jobs report on September 5 will be crucial, with analysts expecting 228,000 new jobs but watching for unemployment spikes. For the common man, the stakes are high. Tariffs could mean pricier cars, clothes, and appliances, while a market correction could dent retirement savings, with the S&P 500's high valuation at 21 times forward earnings, per Reuters, leaving little room for error. As Trump doubles down on his trade war, insisting it will make this country very rich, per the New York Times, Americans are left navigating a shaky economy, hoping for stability in an increasingly uncertain world.